Hello, good afternoon. Thanks for joining us. I'm Nate Zeller, the Chief Investment Strategist here at Secured Retirement. Hopefully, everybody can hear me. Um, if not, let me know. I think we'll go ahead and get started here on this beautiful Monday. Um, Let me get the slides up here. Hopefully, everybody can see the slides. I'm going to do something really quick here. All right. Can everybody see the slides? Or are you looking at me? Well, oh, here we go. There we go. Got the slides going. My apologies. I think we're good to go now. So today we are going to be talking about taxes and how much you really pay. A lot of times we do tax planning in April when our tax returns are due, but we figured this is a good time. We think tax planning's an all the time thing. So we wanted to take a little bit of time now when everybody's going back to school and talk about taxes. We'll begin with our disclaimers. This is not meant to be individual investment advice. Actually, what we're talking about a lot today are taxes more than anything investments. So it's not individual tax advice, and we would, um, advise you to consult a tax advisor before making any big moves with your own situation. So this is just meant to be general information to hopefully guide you and help you make some of these decisions in your planning. Like I said, we're looking at taxes now. The kids are getting ready to go back to school. We thought this would be a good time for us to review a topic near and dear to our hearts, which are our taxes. As most of you are aware, you're paying them, um, and so we wanted to take this time, talk about taxes. Like I said, all year long. This isn't just something that we do in April. This is something we do throughout the year. So a lot of this information we provide will be fairly basic, but hopefully you can get something out of it. We're going to start with a review of how income taxes work. Then we'll discuss how they apply when you are retired and show you how much you really pay in taxes, which I'm sure all of you are aware as you oftentimes write those checks to the IRS in the spring, or if you do an extension in the fall, which is quickly coming up here. We'll also spend a few minutes touching on other types of taxes besides income taxes as well. So let's jump right into it. The most common, oops, I need to switch my slide. There we go. The most common thought of tax is the federal income tax, since that's generally the biggest one, but there's other types of taxes to consider, including state income tax, capital gains tax, taxes on Social Security, sales tax, property tax, and others. As Benjamin Franklin said, nothing's certain except death and taxes. So the income tax, this is the largest tax that most people pay. And I'm guessing that most people in our audience are aware of how this works, but we're going to still cover it and give some of the basics, look at the tax brackets here. So as we know, the federal government collects money to support our military, Social Security, education, health programs, as well as pay interest on the national debt. And so during your working years, what you tend to do is have tax money withheld throughout the year. Then you get to the end of the year, you file your tax return, determine if you paid in more or less, or maybe the right amount. If you paid in less than you needed to cover your tax obligation, then you're writing that check come April, or if you file an extension later in the year. If you paid more than you needed to, then you're due a refund, which is great. You get the money back. Would congratulate you for doing that, but also thank you as a taxpayer that you just loaned the government a lot of money interest free for most of the year. It does get more complicated if there's other income sources. You own a business. We're really not going to get into that today. Investment income as well. We will talk about that a little bit as well. So it oftentimes too does make sense, if you're looking at your taxes, to do a little bit of planning, especially at the end of the year, to see where you're at. If you looks like you're going to be in a lower tax bracket in the next year, maybe it makes sense to put out some income. This is mostly true for people who if they have very variable income, whether it's like say sales commissions or something, or they own a business, or if you're looking to retire, know you will be retiring say next year, and your income tax bracket will be lower. It might make sense to put off some of those things. Taking a look at the tax brackets here, what this shows is a portion of how much of your income you will be paying in taxes based on these amounts. So if we look here right in the middle, for example, you can see that if you pay up to, well, on the first $10,275, you'll be paying 10%. I'm talking about a single tax filer. You can obviously look across if you're married. On the next amount from 10,000 up to 41,000, you pay 12%, and then so on and so forth. It's worth pointing out that there's some pretty big gaps here. That if you're going from 10% to 12%, isn't that big of a jump, but from 12 to 22% is fairly substantial. Then again, from 24 to 32 is a fairly big leap. So if you are looking to do some tax planning, that's probably the areas that deserve the most attention. So let's take a look at an example. So let's assume for a second that you file as a single person and you have an adjusted gross income. So that's after withholdings such as health insurance, 401k contributions, Social Security, and so on. So it's called adjusted gross income of $50,000. Keep the numbers even. So you pay 10% on the first $10,275, and you pay 12% on that amount from $10,276 to $41,775, and then 22% on the amounts above that, because the $50,000 is within the 22% tax bracket. When you total that all up, your total tax is $6,616.66. It gives you what we call an effective tax rate of 13.2%. So basically, that's the amount of your income that you're paying out as taxes to the federal government. And then the marginal tax rate is 22%. So your marginal tax rate is the tax rate that you're in. So if you happen to add any income, whether you decide to maybe take on some overtime at work, or if you have a side hustle of sorts, or maybe you're taking on an extra job for some income, you'll be taxed at that marginal tax rate, the 22%, up until you hit the next tax bracket. The next item we want to discuss is capital gains tax. This is for assets that you hold. Generally, I think for a lot of the people watching this would be stocks, for example. It also can apply to real estate. Anything that's held. There's some different rules for collectibles and so on, but for this example, let's just think about stocks. So capital gains are short-term and long-term. Short-term capital gains is anything held less than a year. Long-term gains are anything held more than a year. Short-term gains are taxed at your ordinary income tax rate. So if we're looking here, and this is for single people, again, there's a similar chart for married people, just the income brackets obviously change. So if it's a short-term gain, it'll be paid at your marginal tax rate that we're just talking about, so the middle column in this chart. If it's a long-term capital gains rate, that'll always be less than your ordinary income tax rate, but at 0%, up to $41,775, 15% for the 22 through 32% tax brackets, and then it's for most of the 35% tax bracket as well. And then above that, it gets to be 20%. And then when you're at that area, there's also the surcharge, another 3.8% on top of that. That's getting pretty high. But the way this works is it gets funny, is that actually capital gains do add to your adjusted gross income. And this can push you into a higher tax bracket. It will not affect your income, your ordinary income, because that's what gets taxed first. So in that example that we gave earlier, if you had a lot of capital gains added to that tax would remain the same. But with a higher adjusted gross income, you may be subject to certain phase outs of deductions and tax credits. You could also lose eligibility for Roth IRA and deductible IRA contributions. So let's look at an example of how this works. So let's assume here that you have an adjusted gross income of $25,000, a realized long-term gain of $50,000. So your total adjusted gross income is $75,000. So on the first 16,755, so we come up with that. The top of the 12% bracket is 41,775. We subtract out the $25,000 adjusted gross income and come up with the 16,755. So the first amount of that gain is taxed at 0%. So there's no tax on that. The remaining 33,225, which is the total 50,000 less the 16,755, taxed at 15%, is just shy of $5,000 in tax. If you really are a numbers person and get into it, you can, calculate out that $5,000 ends up being about 10% total of the total long-term capital gain. But this is more an illustration of how you would pay 0% on a portion and then 15% on a portion for this particular tax bracket. And really emphasize that it makes sense to do some planning if there's a certain time, especially after you retire, maybe before you start to take Social Security or distributions from a taxable IRA. That's probably a very good time to be taking some of your capital gains if you have highly appreciated stock. A lot of people have stock options, for example. That's a good time to start to unload those. You can do some planning to keep it at the 0% if you're in a lower tax bracket, or even paying the 15% could make some sense. State income tax is the next one that we're going to touch on here. Some places also have local income taxes. Fortunately, in Minnesota, there's not one, or Wisconsin for that matter. New York City's the most famous or infamous for having a local tax, income tax. But anyhow, for state income taxes, you can see that in Minnesota, it can be up to 9.85%. The brackets work very much the same as they do on the federal level. Obviously, they're a little bit different. There's fewer brackets, so they don't align with the federal brackets, but they work the same way. And again, you have money withheld from your paycheck throughout the year. Then you get to the end of the year, and you either figure out if you owe money or do a refund. Taking a look at this now, if we're to combine the state and federal taxes, going back to our example from before, if you are a single person, you file singly, adjusted gross income of $50,000. Before we showed the federal income taxes about $6,600. The state income tax, we're not showing the calculations here, but it works very much the same way. $2,992, just shy of $3,000. So your total tax is a little over $9,600. The effective tax rate now is 19.22%, and your marginal tax rate is a 28.8, which is a 22% federal plus 6.8% state. So if any dollar you earned above this, again, I'm talking if you ended up working more hours or had a side hustle, we'll call it, you'd only be keeping about 71 cents of every dollar earned in this example. There's other withholdings to be aware of. Technically, these aren't taxes. There's the FICA, the Federal Insurance Contributions Act, or it goes into Social Security at 6.2%. You pay into Medicare 1.45% throughout your working years. So if you think about how many years you've worked, how much money you've made, how much you've paid in, certainly don't feel bad taking advantage of these government programs because you have been paying for them for a long time. We'll also mention that your employer is paying these same amounts. So combined between you and your employer, you're paying in 12.4% of your income every year into Social Security and about 3% into Medicare. And of course, if you're self-employed, you're paying both. So let's talk about how this affects retirement income. Because we do work primarily with people at or near retirement. I think most of the people on this call are probably fit into that category. And this is really to illustrate the importance of tax planning. And we want to talk about RMDs, required minimum distributions, because those are forced. You're required to take money out of your account. Right now it's age 72. So when you reach that age, the way it works is that at age 72, you take the value of your IRA, well, it's really all of your IRAs as of the previous year end, all of your traditional IRAs, this does not include Roth IRAs, divide it by what's we call your expected lifetime. And these are tables put out by the IRS. So they, if you look here at this example at age 72, statistically speaking, live for another 27.4 years. So you take those year-end values, divide by 27.4, and that's how much money you're required to take out of your IRA. So as a quick example, too, let's say that you happen to have $1.5 million saved up in an IRA, pretty good amount. At age 72, your RMD is $54,744. You can take more than that, but you can't take less. It's the highest penalty that the government IRS um, puts on people. It's a 50% penalty. They'll impose that and plus make you take your RMD. So it's certainly something you don't want to miss out. And it's something that we do track for our clients and help make sure that they do take those. This money is taxed. Any distributions from what we call qualified retirement accounts, with the exception of a Roth IRA, of course, is taxed at ordinary income, both at the state and the federal level. And so if you happen to still be working or have other sources of income, this can really boost you into a higher tax bracket. Joe Lucy calls this the biggest lie, or even the grand illusion, is you're told throughout life, you're working, sock money away in a 401k, because when you take it out, you're going to be in a lower tax bracket. Well, that's not always the case. If you're trying to maintain your lifestyle, for example, you'll still have a lot of the same expenses. You probably won't have some of the deductions that you had earlier in life, such as child tax credits, for example, or even mortgage interest. That's changed a little bit with how the tax code is now. So these tax brackets tend to be the same or sometimes even higher in retirement. And also they are subject to change. So as it stands right now, we have, the tax brackets were lowered a couple of years ago, but that's supposed to, that sunsets and at the end of 2025. So in 2026, tax brackets we know are moving higher, and not to mention all the government debt out there. There's $30 trillion in debt, and the government wants to pay for that. So there's always a chance that later in life, these tax brackets will move even higher. One other item that we wanted to mention here too is if you have a spouse and one of the spouses were to pass away and you both had large IRAs, you both worked, and then you're required, if you both are over age 72 and are required to start taking money out of your required minimum distributions, what happens if one of the spouses were to pass away? That can certainly push you up into a higher tax bracket as well. And so if we're looking at, that example before where I'd mentioned $1.5 million, so let's say two spouses each had $750,000 saved up in 401ks, IRAs, whatever you want to call it. So combined, it's 1.5 million. They're both same age, we'll say taking RMDs. Something happens to one or the other spouse is the beneficiary and stuck. So that $54,774 that when you're filing jointly, puts you solidly in the 12% tax bracket. And we're going to assume here we're not counting in Social Security or any other income. So that's the 12% tax bracket. But if you look, if one of the spouses were to pass away and you're filing singly all of a sudden, but still being required to take out that same amount of money, all of a sudden you're in the 22% tax bracket. So obviously taxes are a big factor there. One other thing worth mentioning with the RMDs is that you can do what's called a qualified charitable distribution, or sometimes referred to as a QCD. And that's a payment from a qualified account directly to a qualified charity. That will satisfy your RMD if you're so charitably inclined, and then you will not have to pay income taxes on it. You don't have to do the full RMD amount. You can do a portion of it, but it is one way that if you have plenty of income, do not really need the RMD, that you can get out of, avoiding the taxes. And maybe if you do the proper planning, it'd save you on the taxes. So you kind of net out in a very similar position as you would have been without doing it. Next is a real quick touch on Social Security. The way that Social Security is taxed, it's not all taxed, but some of it is. What happened back in the 1980s, it's actually 1983, it's President Reagan and bipartisan Congress at the time found a new way to raise income revenue for the government, and they said, okay, let's start to tax Social Security. So they came up with this plan of taxing a certain amount of Social Security. And you can see here what that would be. So the way it's done is finding a combined, or what we call a provisional income, which is your adjusted gross income plus non-taxable interest. So that basically would be interest from municipal bonds, tax-free muni bonds, plus half of your Social Security benefit. And if that ends up being more than $25,000, well, let's look at married joint in this case. If that ends up being more than $32,000, half of your Social Security is subject to taxation. If it's more than 44,000, then it's 85% of your Social Security is subject to taxation. So you can see where that really would add to your tax situation. And if you're combining the RMDs with the Social Security and retirement, as most people do, it can be a pretty good chunk that you're paying the government. A little side note here, it's for those of you fans of the 1980s TV show Cheers, Cliff Clavin, little known fact is that it was a guy by the name of Alan Greenspan, who later became Fed chairman, that was working with President Reagan at the time and proposed this. Another thing worth mentioning is that these income brackets here have never been changed. They're not indexed for inflation like ordinary tax brackets. At the time that they're set up in the 80s, this was a decent amount of income, so the target was to hit the higher earners, or the more wealthy people. But without the index for inflation, now about 56% of Social Security recipients are subject to having their Social Security taxed, or portion of it taxed. Just to throw salt on the wound too, the state of Minnesota is one of 13 states that also taxes Social Security. Wisconsin does not. So if you happen to live across the border, you're saving some money there. The thresholds in Minnesota are a little bit different, but it's still pretty much the same formula. So you are getting hit twice at the federal and the state level on your Social Security. Some other taxes here, just kind of to start wrapping things up. We want to get into, obviously there's property taxes. So if you own a home, even if it's paid off, you still owe money on that, to pay in the county every year to buy textbooks for the school children and keep the roads in good shape, and paying for all that construction that we deal with in the summertime. So thank you for that. There's obviously sales tax. You go buy certain items, most items, I guess clothing is exempt here in Minnesota. There's use taxes. So if you start to add everything up, really, it's easy to see how 30 to 40% or more is subject of your money, ends up being paid in taxes. Then lastly, too, just to touch on the estate tax, this is a whole subject on itself that we could spend quite a bit of time talking about. But basically, when somebody passes away, their estate can be subject to tax. That's the total estate. So this does include any IRAs or investment accounts, taxable, non-taxable, includes your house, any real estate owned, if you own life insurance, for example. So if you think about all of your assets, that can add up fairly quickly. At the federal level, there is an exemption of a little over $12 million. That's what we call portable to a spouse. So it's $24 million. If anybody listening today or watching today is in that situation, please let us know. You're going to need some more detailed estate planning there. At the state level, Minnesota does impose an estate tax. The exemption there is $3 million, so it's a lot less, certainly something to be aware of. And there's not portability with the spouse. The one silver lining, if you can say such a thing, is that the estate tax in Minnesota is anywhere from 13 to 16% versus the federal level, where it does max out at 40%. But again, that's a whole other subject. Let's see here. I think that, this is really kind of getting to the end. I guess in conclusion, I did want to mention there are a lot of types of taxes. This can get fairly complex. There's a lot of moving parts with this, various assets, various sources of income. So it's important to review all sources of income, all of your assets. I keep talking about how, Minnesota, they nickel and dime it. This isn't meant to be an anti-Minnesota thing, so I hesitate to bring this up, but I am going to bring up legendary Packers coach Vince Lombardi. who was quoted as saying, winning is not a sometime thing, it is an all-time thing. Here at Secured Retirement, we kind of have the same mantra that tax planning is not a sometime thing. You don't only do it, when you do your taxes in the spring, it is also an all-time thing. So with that, I guess we'll kind of wrap it up here. We'll get back to our upcoming events. If you have questions, please put them in the chat. I see Gary Edgington sent us a question. Is this the same as regular tax bracket, meaning the first 44% is taxed at 50%, then 85%? So you're referring to the Social Security. I'm going to go back there real quick. Right here, no. And Gary, thanks for bringing this up. It does not bracket that way in the same way that ordinary income tax does. Once you're thrust into this higher bracket, then that total amount is subject to, say, the 85%. So I'm looking here at individual, so it says more than $34,000. So if your provisional income, let's say, for example, is $35,000, 85% of your Social Security is subject to taxation. All right, and any other questions? We'll have the chat open here. I guess our upcoming events. So we are doing our monthly lunch and learn next week. I'll be doing it. I think I'm going to get Joe to help out. We're going to talk about how to protect yourself in a recession, kind of give our views on, whether or not we're in a recession, when we might see one, and then spend quite a bit of time talking about how to best protect yourself. I'm looking at the market today, and I see that the Dow's down. Before we hopped on here, the Dow was down about 500 points. I'm not saying we're in a recession, but bond yields were higher, remembering the teeter-totter, so bond prices were lower. So you need to find ways to protect yourself, and there's a lot of what we'd call non-traditional or alternative ways. So we'll get into some of those next week during our lunch and learn, which live in person here in our St. Louis Park office. Also will be simultaneously webcast. The Monday after that is Labor Day, so no market huddle, and then the next one after that is September 12th. Another question, can we get a copy of the slides or graphics? Certainly. If you want to, the best way to do it, you can send an email requesting to this info@securedretirements.com, or you can send an email directly to me. That's nzeller, N-Z-E-L-L-E-R, @securedretirements.com. All right, any other questions? All right, I don't see any, so I think we'll wrap it up. Thank you all for joining us today. Hopefully you go out and enjoy the remaining days of summer here. And as always, we're here for you. So if you do have questions or want to dive into this in any more detail or discuss your individual situation, please don't hesitate to give us a call. But thank you all and enjoy the rest of your day.